May 22nd, 2026. On this day, one man takes over the most powerful bank in the world, and 99% of Americans are fast asleep. But at this very moment, a process kicks off that decides your money's fate. Not someday, in the next 5 years. This process either doubles your wealth or cuts it in half. And here's the crazy part. It's no accident who wins. It's a pattern, the same pattern. For the third time in 50 years, on one side stand those who get it. Sports car, paid off home, relaxed. On the other, empty account, same apartment as 10 years ago, the same paycheck. The only question that matters today, which side are you on? Stick around. In 11 minutes, you'll understand the game. This is Andy, 34 years old, steady job, steady paycheck, $200 left over every month. Not bad, actually. The problem, those $200 have been sitting in his checking account for years, doing nothing, not growing, actually shrinking, quietly, through inflation. One morning, Andy scrolls through his phone and sees a headline that nearly makes him drop his coffee. One investment up 1,300% in 5 years. And Andy thinks exactly what you might think too. Nonsense, way too late, way too risky. I'll wait for the right moment. But here's the bitter truth, Andy. You had that exact same thought back in 2020, and 2016, and 2012. Every single time. And every time, you sat on that same couch and watched others get rich. The right moment? It doesn't exist. But a pattern, that exists. A pattern almost every finance channel skips because it sounds too simple to be true. Let me show you. Cycle 1. The 1970s. Inflation gallops to 14%. People's money loses value every single month. Panic. Then a man named Volcker cranks the interest rate valve wide open, almost 20%. Loans become unaffordable. Short, brutal pain for everyone. But then something happens almost nobody saw coming. Whoever bought long-term bonds in that moment locked in 15% interest for decades. Remember this line, the Fed creates winners, but never for everyone, only for those who own the right thing at the right moment. Cycle 2. 2008, the financial crisis. Overnight, banks everyone thought were indestructible collapse. The world freezes. The Fed reacts radically, rates to zero, and it prints money, more than ever before in human history. The result 5 years later? Whoever owned stocks, up 200%. Whoever just worked and saved, up 7% in wages, and inflation eats the rest. In other words, whoever owned assets got richer. Whoever only held cash got poorer, in their sleep, without doing anything wrong. And this is where a name comes in you need to remember. Kevin Warsh, the man who just took over the Fed in May 2026. Warsh sat on the board himself in 2008. He saw the money printing from the front row, and in 2011 he threw in the towel because he wouldn't go along with the endless flood of money. This man knows exactly what cheap money does, and of all people, he now has his finger on the rate valve. That's where it gets interesting for you. Cycle 3. 2020. A pandemic shuts down the world. Shops close, streets empty, everyone stays home. And the Fed does exactly what it always does. Rates to zero. The printing press runs hot. Trillions upon trillions flood the system. 5 years later, the same picture. Stocks up 160%. Gold up 125%. Real estate up 45%. And one asset blows them all away. Bitcoin. From $7,000 to over 14 times that, while Andy sat on the couch, waiting for the right moment. Those are the 1,300% that Andy read on his phone that morning. Not made up, not exaggerated, it just happened. And as he reads it, he understands for the first time. He wasn't too late. He was never in. Not in a single one of the 3 cycles. I'm sorry, Andy, but we move on, because now comes the part that matters for you. The 4th cycle has already begun. So what's different in 2026? Three things, and they all push in the same direction. Pay attention. Problem 1. The U.S. sits on a mountain of debt of over $39 trillion. That's around $114,000 per person. You can only get rid of a debt mountain like that one way, without the system collapsing. Low rates and quiet inflation that slowly eats the debt away. And guess who holds the debt and lowers the rates at the same time? Exactly, the same Fed. The same pattern, for the fourth time. Problem 2. Inflation is stubborn. It doesn't drop cleanly to 2%, it keeps flaring up. Your savings keep losing buying power. Problem 3. Geopolitics. Blocked trade routes, swinging oil prices. Every conflict drives prices, and inflation back up. And then there's a president who publicly demands 1% interest rates. Loud. On every stage. He wants cheap money, and he wants it now. On the other side, a new Fed chair who knows exactly where that leads. Two worlds collide here, and your portfolio sits right in the middle. But Warsh isn't clueless. He has a plan. First, the Fed's bloated balance sheet has to shrink. It's still 3 times bigger than before 2008. Second, if technology and productivity push inflation down, he gains room. Then he can cut rates without obeying the pressure from the White House. Third, he's nobody's puppet. He was confirmed without belonging to the president. He decides on his terms, not on command. What does that mean in practice? The markets expect rate cuts still this year. And falling rates mean cheap money comes back into the system. And cheap money always flows the same direction, into assets. Stocks, gold, scarce assets. Just like every cycle before, the only question is whether you're in this time. And here comes the part you've been waiting for. You don't need to be an expert. You don't need to be a trader. You just need one thing: to be invested. I'll show you 4 categories, 4 drawers. You decide how much risk you take, from rock solid to highly speculative. Let's go. Category 1, the foundation, a total market ETF, the S&P 500, or a total world fund. Over 1,600 companies in one product. That's your anchor. In every one of the 3 cycles, this basket won long term. Set it up, auto-invest on, and then the most important thing: don't touch it. Category 2, growth. A NASDAQ 100 ETF. Tech-heavy high swings, not for weak nerves. But these exact tech stocks are the biggest winners of cheap money. Was true in 2009. Was true in 2021. Could be true again now. Category 3, inflation protection, gold, not for fast growth, but as insurance against exactly the money devaluation we just talked about. The good news for you, you don't need a safe or a vault. Through a gold ETF, it all runs comfortably in your brokerage account. A few percent as a hedge is enough. Category 4, speculation, Bitcoin. This is the wild part. High risk, potentially high reward, and nerves of steel because the price swings like crazy. One iron rule: only put money in here that you could lose 100% of without it hurting. Then, and only then, it belongs in the mix. Back to Andy. He now has 2 paths. Path A, $200 a month into an index fund, automatic, emotionless. Every month, no matter what the market does. B, $55 a month turn into around $34,000 in 10 years. No luck, no perfect timing. Path B, keep waiting for the perfect moment, which comes never. And in 10 years, Andy sits on the same couch while someone else leans back, relaxed. And now a tip that costs you nothing: a Roth IRA. The money you put in grows tax-free, and you pull it out tax-free in retirement. That's a gift from the tax code. Most people never open one. And hand money to the IRS every single year. A few clicks at your broker. Do it today, not someday. Let's recap. The Fed's pattern repeats. Not exactly, but recognizably. 3 times it shifted wealth, and every time the same people won. The ones who were prepared. Not the smartest, not the ones with the best timing. The prepared. The 4th cycle has already begun. Low rates are coming, cheap money comes back, the game is on again. This time, you know the rules. Your wealth is no accident. It's a system. And as of today, You know this system better than 99% of people out there. One last thing. This is not investment or tax advice. Just my research, explained simply. You make your own decisions. If this helped you, subscribe to the channel. Real numbers, real mistakes. No luck needed. See you next time.